special show, The State of the Economy. We are about to get the second quarter GDP growth number. That is for the July, August, September quarter. We've just got some numbers for the core sector for October. That's, of course, the next month, not included in this. That's not been very flattering. It's just a 0.1% growth in the core sector. But the 3 months before that are expected to be robust. I am being joined by Kaushik, the Chief Economist from Deutsche Bank, Anubhuti Sahay, the Head of South Asia Economic Research at Standard Chartered Bank, and, of course, the veteran of statistics in India, Dr. Pronab Sen, former Chief Statistician and former Chairman of the Statistics Commission. Well, Dr. Sen, the exact number is still awaited and it should come anytime now. Our poll threw up a 6.4%. That looks like a very optimistic number, a good number that if we get it.
Yes, it would be a very good number indeed. Okay. I don't expect it really to cross 6%.
Okay, that's important. So it's come in at 6.3%. We've just got that number coming in. It's the Reserve Bank of India estimate, 6.3%. So perhaps the first number itself is a positive. We are still awaiting more details. Okay, now we're getting the other numbers as well. 6.3% compared to our poll of 6.4%, but we are splitting hairs over there. The Reserve Bank also had called out for 6.3%. The GVA is 5.6%, again a little lower than I think the 5.9% that we got. The nominal GDP growth has come in at 16.2%. So quite clearly a goodish dose of inflation. So that is GDP counting in current terms, in today's rupee terms, is a growth of 16.2. But if you adjust for inflation, it's a growth of 6.3. What are the sectors that have done well? Clearly, farm sector is the one that surprised on the upside. It's come in at 4.6%. Our poll had expected only 3.2, much like last year. So 4.6, that is a significant contribution to the GDP. The manufacturing sector has, on the other hand, hugely disappointed. The worst numbers I got were about -2. The average I got was 0 or 0.7. It's come in at -4.3. We know that there were chip shortages. There were, several ports in China, etc., not working. Coal was in short supply. Energy wasn't really coming through much. And therefore, some problem was expected. But -4.3 is serious. It's made up to some extent by the services sector, clearly. Meanwhile, mining sector has grown at only, has degrown. Has fallen by 2.8%. That, was mostly on expected lines. But let us see how the services numbers are performing. The construction sector has grown well at 6.6%. That's a good number. We are just waiting for more numbers. But maybe let me just toss this to Dr. Sen. Dr. Sen, you think the surprise has come from services? I haven't yet got the breakup, but I will apprise you. This is a good number, you think?
Well, the thing is, what is really surprising is the agricultural sector.
Yeah.
With the late sowing, which we all know about,
okay.
I think most of us, even 3.2 was a fairly optimistic estimate. So maybe the late sowing problem will show up in the third quarter.
Okay.
But I had thought that it would show up in this quarter itself.
Okay. So we could
That's really where the difference comes in.
Okay.
The services we had always expected to do well.
Okay. So services, now we have the numbers. Trade, hotels, transport and communication, that's a huge one for the GDP. It's, about 20% of the GDP. That's grown very well at 14.7%. Remember, it was most maimed during 2020 and 2021 because of COVID, and that sector has finally responded. Financial real estate has not done all that well. It's 7.2%. The average I had got on the street was about 8.5%. So that's clearly somewhat disappointing. But public administration is disappointed even more. Public administration, defense and other personal services has grown by only 6.5%. So that clearly is disappointment. Dr. Sen, I'll come to you in a minute. Kaushik Das, first thoughts on the number?
So, Latha, we had a 6.2% number, so more or less in line. The surprising fact is obviously manufacturing being, this much negative.
Yeah.
I was expecting, manufacturing to be 1% positive, so it has come at -4%. It has been made up by the trade, hotels, transport that you said 14.7, which means that services sector overall, when you calculate, probably would be above 8%, close to 9%. So, overall, I think, the number is in line with what we thought. And it makes, life a little bit easier because next week we have monetary policy.
Yes.
And if it had come at 5% or something, I'd have had to worry what RBI will do. We would be comfortable holding on to our view about a 35 basis point rate hike based on this data.
Okay, you've answered the next question I would obviously have asked you. But let me get first thoughts from Anubhuti. Anubhuti, I have been able to calculate the private final consumption expenditure in the meanwhile, and that's grown at a decent 9.6%. I heard numbers on the street even up to 12%, but that's 9.6. In any case, first from the output side, is the number to your satisfaction? Anubhuti, you're on mute, I think.
Yeah, sorry. So in terms of our expectation, we were looking at 6.2%. So this number is tad better than our expectation. And I think bulk of the surprise has come primarily from services, which has grown at plus 9%. So I think closer to 9.3%. And the farm sector, which has done much better. We were looking at a 3.9% growth from agri, but it has surpassed even that. Disappointing bit has primarily come from the industry, and of course, as highlighted by Kaushik, the drag is significant from manufacturing. We were looking at a negative number of -1%, but -4% has clearly been quite a bit of a disappointment. On consumption front, as you mentioned, a sense is that when we were looking at those numbers, we were getting a double-digit growth there in private consumption expenditure. But you are highlighting
9.6, 9.7.
Yeah, so it's slightly lower in our view, and in a way, if this has not worked very well in the recent past, but usually domestic trade and private consumption expenditure used to tag along well in the past. So there seems to be a little bit of a divergence here. But I think the bulk of bulk of the disappointment is purely from the manufacturing sector, though other parts have done better than expected if we are focused on the sector-wise classification for GVA.
Okay. I think one big disappointment is government final consumption expenditure. Although private final consumption expenditure has grown by 9.6% to about 22.3 lakh crore, and the gross fixed capital formation also has done well, growing by about 10%, though of course on the street there were people expecting much more. The even 20% number I heard. The government final consumption expenditure is lower at 3.35 lakh crore from 3.5 lakh crore in the second quarter of last year. Dr. Sen, that's puzzling, isn't it? It's down by about 4.5%.
It is actually. But I think, what happens is that by and large, when a lot of these discussions take place, we tend to go by what the central government has been doing.
Yep.
But that data comes out with a fair regularity. And we don't have enough information about what's happening at the state level. That gets compiled later on.
Okay.
And I suspect the problem is with the states.
Okay. And of course, there is a huge import number also, which I think will be eating into the GDP number. The imports have been as high as 12 lakh crore. I mean, I don't remember when I last saw such a large import number. So maybe it is negative exports that is dragging the GDP. Kaushik, you want to tackle that?
So there are two aspects. So if you have net exports subtracting from growth, which would have happened because import growth was higher than export, that would have also reflected in higher investment growth. So you mentioned something like 10-12% growth we got in investment, right? So that balances it out. But I'm not surprised with the government consumption being lower. There's a way to figure that out. If you take fiscal spending for July-September quarter, and nominal fiscal spending was about 9% year-on-year growth. But if you deflate it with the inflation and try to find out the real fiscal spending, you would find that it was negative for July, September because of high inflation. So if I had to project something on the government consumption expenditure, I'm not surprised that it has come on the lower side. And obviously, there was a very adverse base effect. Last year, July, September, the growth was very high in this component. So that's not that surprising. But overall, it's very difficult to, have all the components, forecast right. There's a component called discrepancy. I don't know how much it has contributed or, subtracted from growth. But if you have got it...
You put your finger on it. The discrepancy is 1.1 lakh crore. That's a substantial discrepancy. Last quarter...
Is that positive or negative?
Positive discrepancy.
That means it is adding to growth. So we have to see how much excluding discrepancy. But I'm just saying that if you've got the headline number right, to 6.2, 6.3, I think we have done our job, and Indian economy is on track to get that 7% growth for FY23. So we can expect around 4.5, 4.75% growth in the second half of FY23, and taking the average from the first half, we should be in line to have the 7% growth that has been projected for FY23.
Okay. Anubhuti, you want to take a shot at what Reserve Bank might do looking at this number? It's up to their expectation.
Yeah, absolutely. It's in line with the expectation, but I think we also need to focus on GVA. I'm not sure what your poll threw for GVA, but GVA at 5.6% is lower than our expectation of around 5.8%. Again, not getting into, like 20 basis points or 30 basis points of deviation, but, the gap between GDP and GVA is very large.
Okay.
Of course, it is explained by the drag in the manufacturing sector, but it clearly shows that the economic activity was not as strong as it was expected by economists at large. We were looking at a gap of around 3.4%, 30 to 40 basis points. So I think that's one part which needs to be kept in mind. The other important aspect about this data, especially from the monetary policy perspective, is as you highlighted, it's in line with the RBI's expectation, and it's past data. On which probably RBI has already reacted in the previous monetary policy meetings. Key is how they expect this data to play out in the next 6 months. And there, our sense is that we will start seeing some signs of moderation going forward, both on base effects as well as actual moderation in real economic activity because of higher inflation, higher interest rate, and of course the slowing global demand. That will be the key story from our MPC's perspective, and that should lead to reduced size of rate increases and finally a pause probably in the Feb of 2023.
Okay, so you will go with what, 25 or 35 or?
December is 35 in our view for sure.
Okay. Well, Dr. Sen, before I get to the RBI policy, which of course I'll discuss with you in detail when we meet for the Citizens MPC, what are your thoughts on what Anubhuti is pointing out? Very important. Our poll for GVA said 5.9 and for GDP said 6.4. But the actual number is only 5.6 GVA, much lower than what the street was forecasting. A huge gap actually between the GDP and GVA. How would you interpret that?
GVA is what I was actually looking at. GDP comes out in the wash. And what really matters for the state of the economy is what's happening to the GVA. And the GVA at 5.6 to me is not a great surprise.
Okay.
What is a surprise to me is GDP at 6.3.
Is it explained by the higher subsidies? The Anna Yojana, there were several subsidies. Is that the reason?
No, remember, if the higher subsidy should actually detract from the GDP.
Oh, okay. Sorry.
Okay. It's really the high GST collections which are shown down.
Okay. So higher taxes has boosted the GDP. What would you...
And of course imports. And
yes.
Therefore the tariff collections.
Okay. So both those are things that we should watch out for and, may explain the weakness. How would you think the Reserve Bank will look at this number? Will it look at, 5.6 and worry and therefore bring down the aggression of rate hikes? Or is this not even important?
Frankly, I think the RBI would be perfectly comfortable with these numbers.
Okay.
And the focus should be on what's happening to inflation. The inflation has started moderating, but you can't quite take the foot off the brake yet.
Okay.
So I would go along with my other two panelists. I would say that really it's 35 basis points is about where it's going to be.
Okay. So the overall expectation is for a 7% GDP in the current year. That's the Reserve Bank's number. That's the number that Kaushik spoke about. But looking at this 5.6 GVA, is 7% under threat at all, Dr. Sen?
Yes, I think it is.
Okay.
I think it is certainly under threat. The point is that if you look at the figures, what seems to be happening is, number one, the public expenditure support to the economy is weakening. The consumption is high, but the consumption seems to be driven by import-intensive patterns of consumption.
Yes.
None of which bodes well for future growth prospects.
Okay.
And the problem, when we think about what's happening to the global economy, we always think about it in terms of what's going to happen to our exports. But also keep in mind, Latha, that when the global economy weakens, India looks like the only good market for every other country to target in terms of increasing their exports to us. All right. So expect a lot more import competition than we've seen up to now.
Okay. No, that's a fair point, sir. And that has been a drag. There is a current account deficit issue as well. But for the moment, Kaushik, would you also worry with GVA coming in at 5.6? Is that 7% something you will relook at in your own modeling?
No, Latha. I mean, these numbers we all know are subject to revisions and, very large revisions. So I'll wait for the next few quarters numbers. So it doesn't make any sense to change any forecast, at least on the GDP front. I mean, we are working more with GDP. And the thing is that if you got a number which is close to this quarter's forecast, and then the question is next quarter, October, December, it could be 5%, and then January, March could be 4.5%. We have already baked that in. So we can still achieve 7%. And as I told you, this discrepancy number would be, adjusted somewhere. So you don't know at the end of the day where these numbers will, lie. So no point changing it too much. I think for RBI, what will be important, as Dr. Sen said, is inflation, because the growth numbers are bang on target, what they have given. So I don't think RBI will also change their forecast as of now for GDP, and they'll wait for more data. But then I think we are almost at the end of the rate hike cycle. After this 35 basis points, if it goes up to 6 quarters on the repo rate, I don't think RBI hikes anymore in February, simply because they can see 5% inflation in April, June, and the real interest rates would become positive if you're at 6 quarters. So to that extent, I think, this is the last rate hike probably you'll get in December, and then they'll focus more on growth rather than inflation from next year.
Okay. Well, to be fair, there is another number that they will have to watch out for, the number and the statements that come out from the FOMC on 2nd December. That will have, of course, some kind of an impact. It's expected to be a little dovish and may abet this 35 basis point hike that all of you are expecting. But, there is that other factor as well. Anubhuti, would you want to comment on any of the other entries? Trade hotels doing so well at 14.7%, but not so good when it comes to financial services. How would you rate the services performance?
So Latha, I would, I wouldn't look at a YOY number because there is a lot of distortion. It's very difficult to compare September numbers to June because June was distorted by base. And again, it's very difficult to compare September 22 with September of last year. Yeah. It's a very noisy data. So I think in our view, it's best to look at the CAGR, compounded annual growth rate, of September quarter, 4 quarters moving average for September vis-a-vis the corresponding period in the pre-pandemic. And trade looks good on a YOY basis, but if you look at the CAGR, it is still negative. At minus 0. It's still negative. Okay. It's slightly better than the previous quarter, but it is still negative. So there is still a fair bit of a catch-up, which has to happen in trade, transport, and communication. Financials, real estate segment, which you highlighted, might look depressed on a YY basis, but if you look at the CAGR, it is at least in the positive territory. Okay. In fact, it was better than our expectation. So, just focusing on the YY numbers probably might not give us might not give us the right conclusions. So we would rather like to focus on CAGR, and it shows that trade still has a lot of catch-up to do in the future quarters.
Oh, that's such a brilliantly explained trend, Anubhuti. I think the trade hotels transport is coming in at 6.5 lakh crore, 6.49 lakh crore, and it was 6.4 lakh crore in FY20. 2019-20, trade was contributing 6.4 lakh crore, and then it fell very sharply in the COVID years, obviously because trade wasn't allowed. It fell all the way to about 5 lakh crore. So we have not quite made up, as you say, in terms of compounded annual growth. We are still declined. We are still in a negative terrain as far as trade, hotels, transport and communication is concerned. Maybe a long way to go. Dr. Sen, 2 questions, sir. Your comments on this trade hotel services still showing pain, is it? What would you say about states' expenditure? Let me first get the trade hotels and then I'll come to the states' expenditure. Do you think that there is still a lot of hurt and services has ways to go?
It is. I mean, Latha, the right way to look at it is that a lot of trade hotels and restaurants in particular should be very, 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 very closely connected with consumption expenditures. We have now reached a situation where consumption is significantly above what it was in 1920, FY20. Yeah. But this particular sector lags behind. So what's happening? I mean, is it that our consumption patterns have changed dramatically? It could well be the case, but I frankly don't think that the kind of fear of COVID is still influencing our consumption behavior. So there's something else going on which we need to really think through.
Now, is this what you call corporatization or formalization?
I suspect so. I suspect trade hotels and restaurants is one of the sectors in which there has been a lot of damage to capacity.
Okay. Well, it's very clear. Go ahead, sir.
Yeah. So there's, I think, a capacity problem that's cropping up there.
Okay. Well, we have to keep that in mind because it's also a huge employer, trade, hotels, transport, communication and broadcasting. And that one, as Anubhuti and Dr. Sen are pointing out, is still in deep pain. The entire sector output is just about what it was 3-4 years ago, pre-COVID time. So quite clearly, there must have been a lot of business loss. Dr. Sen, coming back to government expenditure, we saw that public administration is growing at a slower pace of 6.5%. But we were told that in October and November, the states have started ordering a lot. Construction companies told us that as well. The government has given that interest-free loan to states of 1 lakh crore. And many states, we even had, I think, the Tamil Nadu finance minister on record, have drawn it. So do you think that we might, that might be the positive for the third and the fourth quarters? State capex.
That's going to show up in capex, right? But what we are talking about is weakness in public consumption.
I take that, sir. I take that. All I'm saying is that public administration, the last entry in the GDP, has grown only by 6.5%. Do you think government expenditure, state government expenditure in the second half, prodded to some extent by better transfers from the centre, can give a leg up to GDP?
It could. But, Latha, we've been through this before, where the orders that government places doesn't really get counted as government expenditure until government actually makes the payment for it. And the payment sometimes gets delayed. So we've had a situation where payments were delayed by as much as 7 months. Went into 3 quarters later. So I wouldn't hold my breath on that. It would show up in the production numbers of other sectors where the demands are being placed, but would not show up in the expenditures of the government.
All right. I think we will have to leave it at that. Anubhuti, I didn't ask you your full year number. Are you also at 7%?
Yeah, we are at 7% and will maintain that number for the time being.
Okay, so that makes 3 people at 7%, Anubhuti, Kaushik and the RBI. But Dr. Sen believes that looking at the GVA number, that reaching that 7% could be a bit of a worry. This, on the whole, is largely a positive number at 6.3%. It's absolutely in line with what the street was expecting. And the important point is that services seems to have grown. The only worry is that the services sector in the trade, hotels and transport and communication category is still showing deep pain and is nowhere near the robustness it showed 3 years ago before COVID. From the expenditure side, the biggest disappointment comes from net exports, which is a drag. Imports have done much better than exports, so that is a drag. But there is excellent personal consumption expenditure and good capital formation. Both of them have grown in double digits, almost 10%, and that makes this number look good on paper. Let's see how the revisions are, but for the moment, it's a positive set of numbers. Dr. Sen, Kaushik and Anubhuti, thank you very much for joining us with your first cut analysis of the second quarter GDP numbers. We go into a break. There's